Edith Njage here, coming to you from Ariel for Africa. We're so excited about this series, just taking you through successful fundraising for projects and for businesses. One of the key things that I'm going to start with is, should you even be raising capital? I know it's hot. I know it's what all the businesses and startups and SMEs on the continent are doing, but do you need to be giving up equity right now? So one of the key metrics that I normally look at is, number one, when you have a project that has long-term payout versus short-term payout. What do I mean? If the project payout is likely going to be 5 years, you want to have an investor with you and that liquidity throughout that period. But if it's going to happen within a year, do you really need to be giving up equity for it, or can you bootstrap? Which I know businesses don't like to hear, but listen, bootstrapping is actually pretty hard, but we'll talk about that tomorrow. Number two, when you have a new project or new market that you're entering and you do need that liquidity, you do need that buffer, you do need that, sort of protection as you venture into new spaces. And then number three, have you hit $25,000 MRR? This is monthly recurring revenue, because then that gives you the seat right on the table when you're negotiating. You're a lot more powerful because you're not asking investors to help you be bankable. You already bank. Today we'll be looking into bootstrapping. Any founder that's worked with us knows I am massive on bootstrap, bootstrap, bootstrap. What do I mean when I say bootstrap? It basically means tightening your belt as a business. Rather than bringing in capital, focus on reducing your costs and maximizing your revenue. So what does this look like in the beginning for a startup? This essentially looks like you start with what you have. You start with the capital that you may be able to invest yourself. You start with the resources you have. You start with the networks and the connections that you have to generate as much money as possible. The second thing is that you need to manage finances like a boss, like a guru when you're bootstrapping. You need to be on top of your cash flow, your income statements. You need to be on top of budgeting, what's going in, what's coming in, what's going out. The other thing is you need to focus on your client base and how do you grow that? How do you take care of the current clients so that they stay in the business and are repetitive? How do you build brand ambassadors from your clients? And how do you essentially focus on growing that base? And then finally, in line with that is business development, right? So that needs to be a game. But even as you're preparing and you're thinking about a fundraise, before that, look into grants, look into crowdfunding, and look into family and friends that can put loans into your business before you bring an investor. Yesterday we talked bootstrapping. Today we're jumping into equity investment. I know a lot of founders struggle to understand which one do I approach, which one is right for me. There are essentially three categories I'm going to point out. One is private equity, venture capital, and angel investment. So for private equity, this is mostly it applies for established businesses, because what happens is you have firms that pull together the money of wealthy individuals, and they're looking for a more long-term investment. They're looking for controlling stake, and they're looking to be in there 5 to 7 years. The businesses will typically be larger, and the amounts of money is in the millions of dollars to the billions of dollars. So a lot larger. Now, when you look at venture capital here, you're looking for investors that are looking to do 3 to 5 years, but they're looking for high growth, businesses. They're looking for massive traction. They're looking for high value in intellectual property. And here they're essentially looking to put hundreds of thousands of dollars to millions of dollars. Now, for angel investors, this is for the very, very early founders. Here they're looking for thousands of dollars all the way to millions, typically 1 to 3 years. They're looking likely something they'll be passionate about for these investors, and something where there's potential for growth. I hope this helps. So today we'll be talking about how much equity is too much. And I get this question quite a bit. How do I determine how much equity I should be giving an investor that's coming on board? How much is too much? How do we agree? How do I negotiate? etc. So this is a major issue for African founders, because in my experience I've seen I'm trying to find a nice way of saying this, but I've seen people from the West taking advantage, especially of women in business, and getting a lot more equity than they should. So when you're giving equity, it needs to be on the basis of your company valuation. What does this mean? It means you should have done financial projections and you should have done valuation by a few methods. Venture capital, DCF, revenue multiplier. There are quite a few comparables. There are quite a few methods to pick from. So based on the valuation number that you come up with, you then compare that against how much you're trying to raise. So for example, if my valuation has come out as $2 million and I'm trying to raise 200,000, then I should be looking at giving about 10%. But again, this will be on the basis of what's the best case scenario, the base case, and the worst case scenario for all the different situations you have projected on. So it's not random, okay? It's on the basis of the questions I get or comments I get is, Edith, how do we know, right, that we're making a mistake with our capital raise or with our fundraise? And one of the key things is make sure you have the right investor, because this person is going to be sitting on your board and is going to be making decisions, right? They're going to carry weight alongside equity. So not all money is good money. I always say this. Just make sure that it's the right person, the right fit, the right values, the right direction, the right personality. They're bringing the right value on board, the right networks, etc. So it's a lot more important who the person is over the amount of money. Okay, number one. Number two, you don't know the value of your intellectual property. A lot of founders have no idea how to value their IP. And this is major because a lot of times in the early stages especially, this is where majority of your value will come from prior to you having the revenues. Then number three, you have no valuation. So you're giving equity willy-nilly. You have a pitch deck and you think that's enough. X. Wrong. Finally, you're in a rush. Number four, you're really in a rush. I think with a capital raise, take your time. Make sure the people that are helping you with it are taking their time. They're being intentional. They're finding the best fit for you. And then finally, you're not focusing on your revenues. As you're raising capital, increase your revenue.